Welcome to Finance 300. This is your online instructor, Diana Block. And welcome to week 6, where this is our hump week for the class. Well, after this week, we're more than halfway there. And so this week, we're going to look at valuation of stock. And there are a couple of different methods that we're going to examine of how to get the value of stock. And we're also going to look at some concepts related to risk, which we all know risk is, the volatility, the possibility that you might lose your investment. So we're going to talk about that some too. And your reading this week comes out of chapters 8 and 9. So I'm going to use this video to just point out some of the important concepts that you'll want to glean from those chapters. So what I have in front of us now is some information about cash flow from investments, specifically from stock. Now, when we calculated the value of a bond, we were able to calculate that pretty precisely because we knew at what point in the future we were supposed to receive a payment, and we knew what cash flows we were going to receive each year through the coupon. And then with the current market rates, we can calculate exactly what the value of a bond is at this moment. And so we had all the information that we needed to do those calculations. With stock, we have some calculations that we can make, but it's based on a lot of assumptions. We have some expected dividends and maybe a future selling price, but we don't have any kind of precision for that. Public firms are not required to pay common stock dividends, so even if you have a firm that does pay dividends, there's no guarantee that those will always come in. A lot of firms don't even declare dividends at all. And then those that do don't necessarily declare dividends every quarter, and then the amount of those dividends is not necessarily fixed. So that isn't something we can really count on to do calculations like we can with the coupon payment of a bond, where it's a fixed amount for the life of the bond. And then also the future selling price of the stock. We don't know. We can make some guesstimates, some estimates about where the stock will go and what it might sell for a year from now or 5 or 10 years from now. But this is completely speculation. Whereas with a bond, we know exactly how much we're going to get in the future. We're going to get the face value. So different than bonds, stock valuation includes a lot more speculation because we don't know any guaranteed dividends, and we don't know the future selling price with any level of precision. So this cash flow from a bond, in theory, is from a stock, in theory, is similar to a bond in that you'll receive a stream of small payments, which would be dividends, followed by a larger payment, which would be the selling of the stock. So in theory, it should be a similar format of receiving payments from the investment. And so when you are selling your stock, you're actually receiving that payment from another investor rather than the firm. So that's another difference. So let's look at the intrinsic value of a stock. When we look at our stock's value, like I said, we're basing that on some assumptions that we've made about the future cash flow. Based on analysis of the firm, of that industry, ratios that we've looked at of the firm, we made some assumptions about what the cash flows will be, and then we're using that information to calculate the value of the stock. Now, because of the fact that that cash flow is based on some analysis, it can vary from analyst to analyst. This is why we will see some analysts that will recommend a stock as a buy, and another will say hold it, and then yet another will say sell it. Each person's analysis can be different. Each person's view of the fundamental information of the firm may be different. And so when you have different investors, you're going to have different cash flow estimates, and therefore different intrinsic values for the stock. In addition to looking at the cash flow, we can also use growth models to determine the value of a stock. So with a growth model, we're going to base our predicted growth rates on forecasting because we don't know, again, what the actual growth rate will be. We can look at the past to see how much a firm has grown each year, how much their dividends have grown each year. how much their retained income has grown each year, but that doesn't indicate that that's what it's going to do in the future or that it's going to do that consistently. So that's another option, is to look at growth, but still that option has some drawbacks, and it still is not going to give you an exact value. It's going to give you a value based on your estimates of the firm's growth. So as you do your reading in Chapter 8, you're going to see various formulas on how to determine the value of a stock. And you'll just need to keep in mind some of these limitations of those pricing models that we've discussed here. Some stocks don't pay dividends. Those that do may not necessarily pay them consistently. But stocks have value because there is the expectation that at some point the firms are going to pay dividends. So because we expect that at some point they're going to pay dividends, these dividend models can be used to determine what the value of the stock will be if those dividends actually get paid. But again, there are some stocks that don't pay dividends, so that dividend model would not work. And the stocks that do pay dividends, there's no guarantee that they're going to always declare those dividends. A lot of times, firms don't pay dividends when they're profitable because they're using those funds to finance growth. So rather than issuing checks out to the stockholders, they're using those funds to grow the firm and invest in new programs and products and equipment. Excuse me. So there are various reasons why a firm would not pay dividends that don't indicate that they're in financial trouble. Just because a firm isn't paying dividends doesn't mean it's doing poorly. It could be doing well because they don't pay dividends and they're using those funds to finance their growth. So there's a lot that goes into why or why not a firm will pay dividends. And if you're basing a value of the stock on future dividends, that can be a tricky situation. Now let's talk about, I want to talk about risk just a bit because Chapter 9 focuses on risk. And we all know what risk is. It's the volatility, the possibility that you will lose your investment. And everyone who invests has some level of risk aversion. People want to invest and know that they're going to make a return on their investment. There's no guarantee of that, so everybody understands that there is risk in investing in any stock market or any investment. However, sometimes the reward may be greater than the risk, so we'll go ahead and take those risks because we know we're going to make some money later on. And what we have to do, and what we're going to talk about in Chapter 9, is how to measure how much risk there is, and then how to be fairly compensated for the amount of risk that you're taking. So when we talk about the concept of a required return, the required return is the minimum rate that investors will be drawn to purchase a stock based on how risky they believe it is. So because we're all negative about risk, we are averse to risk, but we realize that there's a trade-off between risk and return. We have to take some risks in order to get returns. What we'll do is we'll request higher returns when the risk is higher. When I loan my brother $10, it's a very, very high probability that he's going to pay me back when he said he would. So I'll loan him the $10 and I have confidence that he's going to pay me back. If I loan my sister $10, there's a high possibility that she's not going to pay me back at all. If she does, it's going to be 2 or 3 months after the day she told me she was going to pay me. So that doesn't mean I won't loan it to her, because there's a possibility she may pay me back. But what I may want is to charge her a higher interest rate. And so this is, in a nutshell, what happens when we have financing companies, whether it's a mortgage or a bank loan or any type of financing with a car. Higher returns are required when they're taking more risk. If you're a consumer who has bad credit or a history of poor payment, history, then you may be charged higher rates than someone who is a lesser risk because they make all their payments on time. So the same thing happens with our investments. We may still invest in a stock that is risky, but we're just going to require higher returns as a result of the risk that we're taking. And so the required return on a specific investment depends on the level of risk we perceive in that investment. So that's something I want to point out for you, is when you're reading through chapter 9 and about required returns, make sure you understand that that is based on a perception of risk. Now, in the discussion this week, you're going to look at you're going to take a risk survey to kind of find out where you are as far as taking risks. And there's a lot of factors: your amount of funds you have available to invest, and your age, and where you are in your career, that will go into how you feel about risk, and some just your personal feelings about risk. But this test will help you to kind of narrow down where you fall in the risk aversion category, and then we're going to discuss the results of that in the discussion board this week. So I'm looking forward to talking to you more about risk and required returns there. If you have any questions about the assignments, remember you can always email me, or you can catch me on Blackboard IM during office hours. So I look forward to talking to you, and have a great week.